Are you thinking about buying a home but feel overwhelmed by the mortgage options available? Well, you're not alone. The world of mortgage loans can indeed seem like a labyrinth filled with jargon and complex terms. But don't you worry. We're here to guide you through this maze. Our aim is simple: to demystify mortgage loan options, breaking them down into easy-to-understand concepts that will empower you to make informed decisions. So buckle up and stay tuned as we delve into the world of mortgage loans. You might ask, what exactly is a mortgage? Well, think of a mortgage as a type of loan specifically designed to help you purchase a home. It's like a bridge between you and your dream house. Here's how it works. A lender, often a bank or other financial institution, provides the money you need to buy your home up front. In return, you agree to repay this loan over a certain period of time. This period, known as the term, is typically between 15 and 30 years. The loan is made up of two main components: the principal and the interest. The principal is the actual amount borrowed to purchase the house, while the interest is the cost of borrowing that money. Every month, you'll make payments towards both the principal and the interest. Over time, as you keep making these payments, you'll gradually own more and more of your house. Now that we've covered the basics, let's dive into the different types of mortgage loans available. There's a variety of mortgage loans to choose from, and with each one designed to cater to different needs and circumstances, let's take a deeper dive into these options. First up, we have conventional loans. These are the most common type of mortgage and are offered by private lenders. They come with a fixed interest rate, making them an excellent choice for those who prefer stability. However, they typically require a 20% down payment, which may be a hurdle for some. Next in line are Federal Housing Administration or FHA loans. These are backed by the federal government and are ideal for those with lower credit scores. The down payment can be as low as 3.5%, but you'll need to pay for mortgage insurance, which can increase your monthly payments. Veterans Affairs or VA loans are a fantastic option for veterans, service members, and their families. These loans offer zero down payment and don't require mortgage insurance, making them a very affordable option. However, they do come with a VA funding fee, which varies based on factors like military service and down payment amount. The United States Department of Agriculture or USDA loans are designed for rural home buyers. They offer zero down payment and lower mortgage insurance premiums. However, they're limited to eligible rural and suburban areas, and there are income restrictions to qualify. Jumbo loans are for those looking to borrow more than the conforming loan limits set by the Federal Housing Finance Agency. They're useful for purchasing high-priced or luxury homes, but they come with stricter requirements on credit score and down payment. Construction loans are for home buyers who want to build their own home. These are short-term loans that cover the cost of construction. Once the home is built, you'll need to secure a traditional mortgage to pay off the construction loan. The main drawback is that they're riskier for lenders, so they come with higher interest rates. Lastly, we have 203K loans, a type of FHA loan designed for home buyers who want to renovate or repair their home. The loan covers both the purchase price and the cost of renovations. However, the process can be complex, and you'll have to work with a 203K consultant to oversee the renovations. Each of these loan types has its pros and cons, and what works best for one person may not work for another. It's crucial to consider factors like how much you can afford for a down payment, your credit score, and your long-term financial goals when choosing a loan. With each loan offering something unique, it's important to understand the kind of interest rate they come with. This will help you make an informed decision and choose a loan that suits your needs and circumstances. So, let's move on to discuss the different types of interest rates. Interest rates can greatly affect your repayment amount. Let's dive into the two main types: fixed rate and adjustable rate mortgages. Fixed rate mortgages have an interest rate that remains constant for the life of the loan. This means your monthly payment won't change, making budgeting for your mortgage simpler. It's like having a compass in the wilderness of home financing. No matter what happens in the market, your interest rate stays the same. On the other hand, adjustable rate mortgages, or ARMs, have interest rates that can change over time. Initially, ARMs often offer lower interest rates than fixed-rate mortgages. However, after a set period, these rates can increase or decrease based on market conditions. It's a bit like riding a financial roller coaster, with the potential for thrilling lows but also dizzying highs. So which type should you choose? Well, that depends on your financial situation and your expectations about the future. If you prefer stability and plan to stay in your home for a long time, a fixed-rate mortgage might be the best choice. But if you're comfortable with a bit of risk and plan to move before the rate adjustment period, an adjustable rate mortgage could save you money. Remember, the goal is to pick the type of interest rate that aligns best with your financial goals and tolerance for risk. Just as crucial as interest rate is the length of your loan term. The term of your loan can have a significant impact on your monthly payments. This is the period over which you will repay the loan in full. Standard loan terms are typically 15, 20, or 30 years, although they can be shorter or longer depending on the lender and your specific circumstances. Let's break it down. A 15-year term will have higher monthly payments, but you'll pay off your home in half the time compared to a 30-year term. You'll also pay significantly less in total interest over the life of the loan. However, these higher payments might be a stretch for some budgets. A 30-year term, on the other hand, comes with lower monthly payments. This can make homeownership more accessible, especially for first-time buyers. But keep in mind, you'll be paying interest for twice as long, which means you'll end up paying more in total interest over the life of the loan. Now, a 20-year term is a middle ground between the two. It offers a balance between manageable monthly payments and a reasonable total interest cost. When choosing a term, consider your long-term financial goals. If you're looking to build equity quickly and pay less interest, a shorter term might be your best bet. But if you need to keep your monthly expenses low, a longer term could be the way to go. Another crucial factor to consider is mortgage insurance. A mortgage insurance can be a lifesaver, but when is it required? You might be asking this question when you're exploring mortgage options. Mortgage insurance, in simple terms, is a policy that protects lenders from losses if a borrower defaults on their mortgage. It's typically required when a borrower makes a down payment of less than 20% on a home. This insurance can be a crucial safety net for lenders, but it also means an extra cost for borrowers. Now, let's differentiate between two common types of mortgage insurance: private mortgage insurance, or PMI, and mortgage insurance premium, or MIP. PMI is associated with conventional loans, while MIP is tied to government-backed loans like FHA loans. Remember, the cost and requirements for these insurances can vary, so it's essential to understand what you're signing up for when choosing a mortgage plan. Now, let's take a look at how to get the best mortgage rate. Scene script. Everyone wants the best mortgage rate, but how do you get it? Let's delve into some strategies that could help you secure a favorable mortgage rate. First, we'll look at the importance of your credit score. Your credit score is like your financial report card, and lenders use it to judge your creditworthiness. A high score can open the door to lower interest rates. So, if your score is less than stellar, consider taking steps to improve it before applying for a mortgage. Paying bills on time, reducing your credit card balances, and correcting any errors on your credit report can all help boost your score. Next, let's talk about debt-to-income ratios, or DTI. This is a measure of your monthly debt payments compared to your gross monthly income. Lenders use this ratio to determine how well you manage your debt and whether you can afford to take on a mortgage. So, the lower your DTI, the better your chances of getting a desirable mortgage rate. You can lower your DTI by paying off debts or increasing your income. Now, Onto the process of shopping around. It may be tempting to accept the first offer you receive, but it's usually in your best interest to explore different lenders and compare their rates. You'd be surprised at how much you can save over the life of your loan by securing a slightly lower interest rate. Lastly, let's not forget the importance of a stable income. Lenders want to see that you have a regular income and the ability to make your mortgage payments. If you're self-employed or have an irregular income, you'll need to provide extra evidence of your financial stability. And there you have it. These are some of the key strategies to secure a better mortgage rate: improving your credit score, reducing your debt-to-income ratio, shopping around for the best rates, and demonstrating a stable income. Remember, securing a mortgage is a significant step. It's not just about finding a home, it's about making a long-term financial commitment. So, take your time, do your homework, and make the best decision for your future. We've covered a lot of ground today, from defining what a mortgage is to breaking down the various types of loans, interest rates, and loan terms. We've unveiled the complexities of the mortgage world. Remember, consultation with loan officers and the use of mortgage calculators can be your best tools in this journey. So, as we wrap up, let's put this knowledge into action. Start exploring your mortgage options today and take the first step towards owning your dream home. Let's address some common questions or concerns about mortgages. Firstly, what is the importance of a good credit score? A credit score is essentially a numerical expression that evaluates the creditworthiness of an individual. A higher credit score indicates a healthier credit history, making you more appealing to lenders. It can open doors to lower interest rates, higher loan amounts, and more favorable terms. Next, why are there so many types of mortgage loans? Each loan type serves a different purpose and is designed to accommodate various financial situations and home buying needs. For example, conventional loans are typically for those with a strong credit history and stable income, while FHA loans are more accommodating to those with lower credit scores and first-time home buyers. Moving on, what's the difference between fixed-rate and adjustable-rate mortgages? With a fixed-rate mortgage, your interest rate remains the same for the life of the loan, giving you predictable monthly payments. An adjustable-rate mortgage, on the other hand, has a rate that can change over time, typically after an initial fixed period. This could mean lower payments initially, but potential increases down the line. Another common query is, what is mortgage insurance and why is it necessary? Mortgage insurance protects the lender in case a borrower defaults on their mortgage. It's typically required for loans where the down payment is less than 20% of the home's purchase price. This includes most government-backed loans like FHA and USDA loans. The question, how can I reduce my mortgage term, often comes up. Reducing your mortgage term can save you a significant amount in interest over the life of the loan. This can be achieved by refinancing into a shorter-term loan or by making extra payments towards your principal. What factors influence mortgage rates is another common concern. Several factors can influence your mortgage rate, including your credit score, down payment, loan term, and current market conditions. By improving your credit score and saving for a larger down payment, you can potentially secure a lower rate. And lastly, what is the best way to compare mortgage offers? The best way to compare offers is by looking at the annual percentage rate, APR, which includes not only the interest rate, but also the lender fees. You should also consider the loan term, the type of interest rate, fixed or adjustable, and any special features or requirements. We hope we've answered some of your questions. We've reached the end of our journey today. It's been a pleasure to guide you through the intricate world of mortgage loans. We hope that you feel more equipped to navigate the complex landscape of home buying and that you found the information we've shared to be both enlightening and empowering. Remember, the decision you make today will shape your financial future for years to come. So take your time, do your research, and never hesitate to ask questions. Each mortgage loan option we've discussed has its own unique benefits and potential drawbacks. It's all about finding the one that fits your unique situation the best. We love hearing from you. So if you have any further questions, or if there's anything you'd like us to delve deeper into, feel free to leave a comment. Don't forget to subscribe for more insightful content like this. Thank you for joining us today. And remember, the home of your dreams is just a mortgage away.